This week's number, $2.3 billion. That's the estimated record amount Americans spent on fireworks this year. 3 times more than in 2012. Fireworks are like sex for me. I'm always pleasantly surprised when it goes longer than a few seconds. Welcome to Prof G Markets. Today, we're discussing the Nasdaq rally, Meta's Twitter competitor, and Yahoo's potential comeback. Here with the news is Prof G media analyst Ed Elson. Ed, what is going on?
Not much here, but I want to hear the entire rundown on Mykonos. How's Greece treating you?
So it's great. It's Mykonos is a cross between Saint-Tropez and Ibiza, sort of somewhere between douche and bag, like that space in between those two words. Anyways, wonderful. Where are you, Ed?
I'm in New York.
Yeah.
I'm going to be in Mykonos at the end of the month, though.
Really?
So you got to give me all the recommendations. Yeah, that's right.
Yeah, I get the sense
I
you
can't
and I
wait.
are probably not going to hang out at the same places. But I get recognized by students. I have 5,600 alumni of my brand strategy course. And some statistician told me that anywhere in the world where I am in a room with more than 300 people, there's like a 40% chance I have a student in the room. And it inevitably happens when I'm in a place like this. And it's always the same thing. I hear this very surprised voice go, Professor Galloway, which is their way of saying, what the fuck are you doing here, old man?
What are you
You're not
doing?
supposed to be here. Anyways, break down the headlines. Let's get back to the markets.
Let's do it. Let's start with our quarterly review of market vitals. The S&P 500 gained 8%. The dollar rose marginally. Bitcoin was up 7%. And the yield on 10-year treasuries rose 9%. Shifting to the headlines. The Screen Actors Guild, which includes some of Hollywood's biggest stars, is poised to join the writers on strike if the union and studios don't reach a contract agreement by July 12th. Meanwhile, negotiations between UPS and the Teamsters Union, which we covered in our last episode, fell through. It's looking more and more likely that UPS's 340,000 workers will strike at the end of the month. Goldman Sachs is looking to end its partnership with Apple. Goldman has provided banking for the Apple credit card and the Apple high-yield savings account for the past 4 years. That move was part of Goldman's effort to get into consumer banking and lending, an effort that has largely failed. Separately, supply chain sources are claiming that Apple is slashing its production forecasts for the Vision Pro headset. It has also reportedly pushed back its plans for a more affordable version of the device. Apple unveiled that product just 1 month ago. And finally, furniture company Overstock is rebranding its US website to Bed Bath & Beyond. Overstock purchased the company's intellectual property assets in a bankruptcy auction in June. And after announcing the rebrand, Overstock shares popped 65%. Scott, any reactions?
So there's bias all over my comments here. The first bias is I have a bias for or toward Goldman. I like them. They manage my money or they play a role in it. And I generally find that it's smart, good people doing great work. So I have a bias toward Goldman Sachs. I know David Solomon and I like him. I think that there's just no getting around it. You don't want to do anything that costs or where you lose $3 billion. But I would argue a firm like Goldman should be on a regular basis trying new things that are, feel mildly crazy at the time. I think Goldman Sachs is the best brand in B2B. I don't think there's any self-expressive benefit brand like Goldman. Every entrepreneur in the 90s that I hung out with, we all dreamt of taking our companies public, but specifically have Goldman Sachs on, front left on the prospectus cover. And I noticed how I dropped at Goldman Sachs manages my money because that probably means I have some money to manage. And working at Goldman Sachs is tremendously validating, or it's a great credential, a great experience, great accelerator for your career. So I think they do a great job in B2B. Their forays into B2C, you could argue, say, well, all right, this is an amazing brand. It's a global brand. There's a lot of people that would like to engage with the Goldman Sachs brand. And there's a lot of companies in the payment space, et cetera. It makes sense for Goldman to try and get in it. So in the military, they assess an officer's performance based on his or her decisions at the moment, given the information available, not the outcome. But they try to say, distinct of the outcome, based on the information this person was given or had to deal with at the time, did they make the right decision? And I would argue that trying to innovate or experiment around consumer, whenever it was 3 or 5 years ago, was probably the right move. And what's also the right move, quite frankly, is saying this didn't work and pulling the plug. Because $3 billion is real money. But for Goldman, that doesn't even kind of ruin the year. That's not a ton of money for them. Look at Meta, which is burning $1.2 billion a month on their fever dreams of a headset. So again, some bias here, but I think innovating, trying new stuff, and then when it's not working, pulling the plug is the sign of a firm that's doing something right. If they keep doing that, if they keep swinging and missing, obviously they've got to change their approach to the business or change management. But I don't see this as any reason why you'd want to target the firm or change management or anything like that. Apple product forecast.
What do you think of? What do you think of David Solomon's reputation right now? Because he's been in a lot of hot water. I mean, he hasn't ruined anything by any means, but he's reduced partner bonuses. And then there was that story that came out that Lloyd Blankfein, who's the former CEO of Goldman, has been criticizing him specifically for not spending enough time at the company, jetting around on the private planes, and most of all, being a side hustle DJ, DJing at nightclubs and festivals and DJing at Coachella this year. What do you think of DJ Diesel's side hustle?
So first off, it says more about Lloyd than it says about David, and that is, it's just bad form for the former CEO to shitpost the new CEO. And it
wasn't a public statement, but he said it. I mean, it was leaked to a reporter, but yeah.
Oh, okay. So he went on background or whatever it was. It makes, when you are at an organization in your successor, an organization that made you very wealthy and your successor's there, you just demonstrate some grace. There's no upside for him to shitpost his successor. The thing I really don't get, and again, there's some bias here because I know David and I like him and I like Goldman Sachs, but the whole DJing thing, would they rather he played golf 12 hours a week? I mean, what is the problem? It offends their waspy old man sensibility that this guy likes to DJ. And I would like to see Lloyd's jet use while he was CEO. The bottom line is when you have access to a jet, this is what you do. You use it because it's really nice. And if you don't want jets and you don't want your CEO taking jets, then sell the jets. My guess is Goldman has several of them. And I would make an argument that every Fortune 500 company should have jets because if they can get the CEO to somewhere and back and save 1 or 2 days of that person's time every month, it pays for itself. But the thing I just don't get is, okay, he should be playing croquet or drinking Pim's cups and Aperol spritzes and doing all the nice things that respectable white people are supposed to do. I just don't get, I don't get the issue around DJing. It's fun. I've made fun of him for it. But I don't understand. I don't understand the criticism around his specific hobbies. He gets to do what he wants to do off the clock. And the truth is in the numbers. The company hasn't outperformed. It hasn't underperformed. It's performed, distinct of some of the risks it's taken. So I don't, and if you look at what's happened at the board level, they just put a guy named, I think his name's Thomas Montag on the board. And he's a Solomon ally. Now, David Solomon doesn't get to choose the board members. He has influence, but the Nominating and Governance Committee, which is a subcommittee of the board, is the person or the group that gets to identify, interview, and invite new board members. And what this is saying is the following, is that the board universally supports their CEO and wanted to send a signal that, A, we're adding qualified board members who also support the CEO. So I think that Goldman plays such an outsized role in the zeitgeist of our society, and people always look at them as like this giant squid on the face of the economy. I've never understood that either. So I think this is one of these stories that's gotten whipped up into a frenzy across the media. I don't think there's a there. Now, famous last words, they might clear out the entire management staff on tomorrow, but I don't think so. The company seems to be performing. They're trying to innovate. So, okay, so he DJs, okay, fine. In terms of some of the other stuff, Apple hitting $3 trillion, it's great to be the ultimate luxury brand across 1 billion wealthiest people. They're firing on all cylinders. But more bias here, the reports or the rumors that the production units ordered for the mixed reality headset have been cut back dramatically. Jason Stavros, our editor-in-chief, pointed out that you can't draw anything from these rumors, that he immediately forwarded articles with all sorts of inaccuracies based on unit production volume demand forecasts from various sources. However, because I want to talk my own book here, I think that these are in fact true, and that this is what I'm more confident in. Whatever Apple does here, whatever they produce, they have to produce less than demand, because Apple is a luxury brand, and key to being a luxury brand is the illusion of scarcity. So their economists with their econometric models and their demand forecasting have said, we think the demand for this product on day one will be X. That means we need to produce 0.6x, because we need to show lines. We need to see online chatter that not everyone can get one. That is the entire shooting match around a luxury brand. And the fact that they have reduced that number, if you believe they have, and then tried to blame it on manufacturing or supply chain. First off, if Apple can produce one of anything, they can produce a million of them. Apple has the strongest supply chain in the world. That was Tim Cook's background. So again, I'm backfilling my own, I'm using this data more like a drunk uses a lamppost, more for support than illumination, but I'm assuming it's true, and that this thing so far, this value proposition at this price point doesn't make a whole lot of sense. What are your thoughts?
Well, yeah, I think what Jason was pointing out isn't necessarily that the data is false, but just that it's meaningless, which I basically agree with, because he sent all of these articles showing throughout history, this article always comes out. So in 2013, Wall Street Journal headline, Apple has cut its orders for iPhone 5 components due to weaker than expected demand. In 2015, Apple has cut as much as 10% of its component orders driven by weak demand. 2018, Apple to cut iPhone 10 production in the face of weak demand. And, there are like 10 of these articles going through every single year. And it seems like every time there is a supply chain issuer who is saying, we got around 10 to 20 to 30% less production orders. So we think that it's a signal of weaker demand. I think his point is basically like, we've seen this 1,000 times. It almost never has a meaningful impact on Apple stock or on demand as a whole. So we can't draw any conclusions from it, which I liked the thesis, and now I pretty much completely agree with the thesis.
Well, I love how you use the word thesis over and over. So in the final story, I thought that kind of the most innovative move was Overstock rebranding Bed Bath & Beyond. I think that's genius. They bought this thing for pennies on the dollar. And if you look at Overstock has always been like the cockroach of the internet. Like, none of us got it. It was always the little engine that couldn't and then could, and somehow it's just survived through all this shit. They had this crazy founder who would always do this nutty, I think he was a crazy Mormon guy, which is redundant, which is a hate crime, which by the way demands disclosure that, Ed, I fucking love Mormons. Let me tell you my story about Mormons. I grew up, my closest friend in junior high and high school was Brett Jarvis from the Jarvis family, this lovely family, and I used to play on all the church's sports teams. One of my first dates was with a woman named Elizabeth Pettit, who was a Mormon. So not a lot of action there. Ed. I'm one of the reasons I think I lost my virginity at 19 is I hung out with Mormons for way too long. But in general, I don't think it's a bad idea for the son of a single mother who's kind of an underachiever to be hanging out with Mormons. They're super into sports. They don't drink. They're super into family, nice people, very achievement-oriented. Like, Mormons kill it. Everyone talks about how Jews rule the world, which is obviously an anti-Semitic trope meant to create fear. But actually, Mormons kill it. I mean, these Mormons are probably, Jesus Christ, I think the Mormon church has like $200 billion. Anyways, don't know how I got here. Overstock was always like, they've always survived. They literally are like nuclear winter couldn't take these guys out. They've been around for 20 years. And what a genius move. I think their stock is up 60% since renaming it. I think it's a really fun and innovative and out of the box way to think about it. So we are changing the name of this podcast to the Bed Bath and Beyond Pod. Or we're the Lululemon Pod. Pick your favorite.
First.
We're the Kmart podcast. There we go.
That's our brand. Okay, let's move on to our first story. The Nasdaq closed out the first 6 months of this year up 32%. That's the best first half for the tech-heavy index since 1983, when it rose 37%. Now, this rise was largely fueled by big tech stocks such as Meta, up 140%, Nvidia, up 190%, and Apple, which recently hit $3 trillion in market cap, the first company in history to do so. The Nasdaq is riding multiple tailwinds. For one, it's coming off the back of a massive drawdown in 2022, which saw the index lose a third of its value. It's also benefiting from widespread cost-cutting measures in the tech industry. We've seen mass layoffs, for example, at Google, Meta, and Amazon, among others. And of course, there's the AI wave, which has re-injected speculation and optimism back into the market. But Scott, in your view, what's been the biggest driver of this year's bull market?
Well, they say markets climb a wall of worry, and we've been a month away from this recession for 18 months, and the recession just never showed up. But at the same time, it provided big tech companies cloud cover to cut costs. And these were companies that had grown their expense line for 20 years, and then given the chance and the opportunity to lay off 10, 20, or in the case of Twitter, 80% of their workforce. And the majority of their costs are people.
Yeah.
It's not plant property and equipment. So, almost all of this cost just flowed straight to the bottom line. So this year of efficiency, as Zuckerberg called it, has really been the theme across a lot of internet stocks. And we said at the beginning of the year that our prediction was Q4, you would see these companies, their revenue growth would be good, not great, but they would have their most profitable quarters in history. And this entire generation, or this entire management philosophy in the 80s was called re-engineering. And basically from 1945 on, we had a monopoly on the global economy. We took the two most productive cultures in the world, Germany and Japan, and we just leveled them. So we had a monopoly on everything from cars to pharmaceuticals to fertilizers. And as a result, every company just kept hiring more people and pushing into more markets and making more money. And then the Germans and the Japanese caught up, and then the Brazilians wanted in on the game, and then China started to rise. And all of a sudden, companies found that there was fat everywhere. And the big trend in re-engineering in the 80s was anyone with the term vice president or senior vice president, fire them. And the next day, your consumer and your shareholders won't know that they're gone. And that's kind of what happened here. So these companies are in fighting shape, and the economy is actually much stronger than anyone anticipated. And then the chaser, Ed, for all of this is the greed glands and the animal spirits inspired by AI. And as a few stocks go, there goes the Nasdaq. Nvidia's up. Nvidia's tripled this year. Meta's up 145%, Tesla 129%, Apple, Amazon, and Google are all up 40% year to date. So when you have companies, I think Apple's 5% of the Nasdaq or something like that. So when these companies are performing this strongly, it means the Nasdaq is up. So what do we have here? We had the wall of worry that the market was climbing, a lot of money on the sidelines. The recession never showed up, but they absolutely got in fighting shape and cut all of these expenses, which flowed straight to the bottom line. And then the animal spirits came back, and probably more people buying on margin, more retail investors coming back in, which is to set the markets on fire. But there's no getting around it. The best first half in, 40 years for the NASDAQ? That's striking. And now what does that mean? And that means the back half of the year is going to be the best back half in a long time for IPOs. So we're setting up a flurry of new issuances. We're setting up a flurry of investment banking activity. And by the way, investment banking activity has been just dormant for the last 12 or 18 months. So what's interesting is not only what happened, when the first half of the year is the best in 40, but what that means for the last half of the year.
Yeah. I mentioned the phrase bull market, which, around 60% of investors would say that we are in a bull market right now. And then we had this historic NASDAQ rally. But you also mentioned the weighting of those tech stocks. So if you look at Microsoft, Apple, Google, Amazon, Nvidia, Meta, Tesla, they make up 50% of the total weight of the NASDAQ. And Microsoft and Apple alone are a quarter of the NASDAQ's market cap. And then, so I look at what's happened to the NASDAQ, and then you compare it to the S&P 500, which is up 15% in the first half of this year, which is pretty good. But then you compare it to the Russell 2000, which is the 2000 next biggest US companies, and that's only up 7%. So it sort of feels like this is purely a big tech rally that's happening right now. But a lot of people are describing it as an overall bull market. Do you think that we have officially entered a bull market, or is this just a bear market rally that's being buoyed by the big tech companies?
Well, a couple of things. Size matters. These companies just sort of dictate what. I mean, keep in mind, Apple is bigger now than the entire UK stock market, just one stock. So these
Yeah.
companies are so big, and these are indices, meaning they're weighted. So when Apple goes up
Right.
20%, that probably means the entire Nasdaq is up 2%. Now, also, it's your entry point. So Nasdaq shed a third of its value in 2022, which means just to get back to where it was in its highs of 2021, it needs to go up 50%. So it going up 50% just means it's back to 2021. So it's bouncing off of lows, if you will. And then again,
Hmm.
150,000 workers laid off, pretty high cost employees. I bet that's probably 30 billion in annual revenues, money saved that doesn't appear to have hindered or slowed growth, and it's all dropped to the bottom line. So this is sort of the perfect storm of good things for the market. The key question is, where do we go from here? You have
Hmm.
Apple trading at 29 times earnings. It peaked at 35. Its earnings have gone up, so it's come back to a multiple of 29, but its 10-year average, I think, is around 17 or 18. So will we see a bit of a
Yeah.
reversion to the mean? Or are we off to the races again with a few high profile, AI driven crazy stocks like Nvidia or, Tesla's just on a tear? Are we going to see some IPOs that light up the market? In other words, are we back to the go-go days? And I would argue that for the next 6 months, whether we are or we aren't, it's going to feel that way because the market has decided. The market feels like it's got permission again to head to the men's room and do some rails. It's like, okay, it's fucking party
Yeah.
time. Let's lever up. Let's buy
Yeah.
some margin. We don't want to miss out, and the animal spirits are back.
Yeah, I just want to bring it back to small cap companies that I mentioned in the Russell 2000 index. So if you look at the Nasdaq, the average price to earnings ratio across the Nasdaq 100 is 31 times right now, and a year ago it was 25 times. So it's a 25% increase. And if you look at the Russell 2000, the average PE ratio is 27, and a year ago it was 46. So that's a 40% decrease from a year ago. And basically what it feels like is all of this momentum that was in small cap stocks has basically just been stolen and injected into the top 100, mostly tech companies. And I'm wondering, from your perspective, it feels like we are returning to this big, big, big tech era. Do you think that this is overall a good thing for the markets? I mean, it's probably a good thing for investors. Investors are feeling more optimistic now, but it also means that the power and the wealth is getting concentrated into a smaller number of companies at the top. So how do you feel about that switch?
Yeah, I think that's the correct question and an astute observation, and that is, it's good for the markets if you're just invested in index funds because these index funds are dominated by these big players, and the big players are way up. You're probably feeling pretty good about your 401k now. The problem is the ecosystem healthy? And that is, in an ecosystem, you need a diversity of species. And it's just, I've been watching all of these nature shows, and there are more birds in captivity now than there are birds in the wild because of chickens, because we have so many chickens being raised and then slaughtered for, our chicken gyros. And there's like, I think the human mass or the mass of humans and their pets now surpasses or is greater than the entire mass of every mammal on the planet. I mean, there really is an
Oh my
extinction taking
God,
place. And I
that's
look
a
at
crazy stat.
I look at basically the big tech companies, and they're the apex predators. And small companies, the ecosystem, they try to bubble up, they try to survive. But this is really a segue to our next story. There's nothing like the bundling power and the capital and the brand equity of an Apple or a Meta, or
Hmm.
the good money is
Hmm.
always on the big tech incumbent right now. So the opportunity to ever buy into kind of big tech at what looks like a reasonable multiple is just that. It's an opportunity.
Well, yeah, that's a good transition to our second story. Meta launched its own rival to Twitter, a text-based social media platform called Threads. Within the first 7 hours, it had 10 million users. The app works just like Twitter. It lets you publish short-form written posts, like them, and reply to them. And it's also linked directly to Instagram, meaning Instagram's 2 billion monthly active users can easily transport their username and followers onto the new platform. Now, Threads is one of several new Twitter competitors to emerge in recent years. There's Mastodon, Jack Dorsey's Blue Sky, Trump-backed Truth Social, and Scott's own portfolio company, Post News. However, none have yet been able to rival Twitter's user count. As of 2022, that user count was 240 million. Scott, basic question, do you think Threads will be a success?
I think Threads is going to be arguably the best product launch of 2023. I think he's just in round one of the cage match between Musk and Zuckerberg. Zuckerberg is kicking the shit out of Musk. I've been on this thing for now a total of 7 hours. We signed up earlier today, and I think I've already got 7,000 followers. And the ability to just click a button and say, follow all of my followers. I mean, here's the problem with Post, with Mastodon, with Blue Sky. That is, their feature functionality is really strong. They have great innovators. Jack Dorsey's a great product guy. Noam Bardeen is arguably the best product guy in the world. He invented Waze. He's at Post. I love Post News. It's got a better feel, better vibe, more news focus. But here's the problem. It's work. All of these things are work to get back to 10, 20, 30,000 followers. I've spent the last 15 years getting to 550 on Twitter. That's a huge moat. And I'm just like, do I really want to invest? I think most people are like, do I really want to invest the time and energy to get back to this, even distinct of how shitty Elon Musk is and his behavior? And what you have with Meta, or what you have with Threads, is a couple things. One, you have a group of executives. This is what they do. This isn't a rocket guy. If Mark Zuckerberg decided he was going to build a launch vehicle that tried to get into space to launch satellites, I wouldn't be surprised if it didn't work that well. That is what Musk is trying to do, all of a sudden deciding he's a media guy. He clearly has no fucking idea what he's doing. These individuals are responsible for 2/3 of the social media traffic in the world. They have all the advertiser relationships. They have the technology, the ad stack. They know how to whip up a social media pro. I mean, they know how to do this shit. They also know how to depress the shit out of teens and make us feel worse about ourselves and spread misinformation. But I'm going to ignore that. As it relates to social media and building shareholder value and audiences, these guys come to play. They're very good. And with a flip of the switch, I'm already at letter L within 7 hours. And that is just, he's going to take a cannon of 3 billion monthly users and point it at his new thing, Threads, because there is ego involved here. He controls the company. He genuinely does not like Musk. And you have what is effectively a very interesting case in disruption. And that is, disruption is more a function of the incumbents than it is of the disruptor. What do I mean by that? It wasn't that Amazon was that big a disruptor. It was infinitely cheap capital, good execution. But what made Amazon Amazon was that grocery stores and department stores and book and record stores sucked, and they hadn't changed in 40 years. Netflix was amazing, but more than how amazing Netflix was just how shitty and expensive ad-supported cable television had become, where you got 21 minutes of content for enduring 9 minutes of ads telling you to buy a South Korean car, a light beer, or that your legs were restless. So boom, in came the disruptor. And what do we have here? We have a $5 or a $2 billion company that used to be a $5 billion company that acts and behaves like a reckless man-child. I mean, it's literally like the management team is a raccoon on meth, the decisions they make. It's like, what the fuck is this thing doing? And he's coming in. It looks good. It feels good. It feels very Twittery. Anyways, Ed, I think it's going to be a huge. I think he's going to get, it's already the fastest 0 to 10 million platform in history. It's faster than OpenAI. It's faster than TikTok. I think this thing is a monster and is going to do really well for Meta. What are your thoughts?
Well, I wanted to ask you, as you're sort of the target creator for a platform like Threads, and when I think about, I set up my Threads account. I haven't really done anything with it, but I'm feeling the same issue as you, which is I've invested all of this time into Twitter, and I don't really want to see this big seismic shift over onto Threads, because then I'm going to start feeling, okay, well, I've wasted all my time and I don't want to start from the ground up on Threads. And I guess my question to you is, what really is the value proposition for moving to Threads? Because when I look at the product, it's the same product. There's basically no difference. It looks a little nicer. The only benefit, in my view, is that you don't have the slight anxiety of, I forget how you put it, something like raccoon on meth management. and that slight threat and that slight risk that could ruin the product, and your work will go to waste or whatever that is. So I guess my question is to you is it because you think that the product is better? Is it because you're worried about what Elon will do to the company? Or is it simply, and this is a hunch that I feel about you don't like Elon, you don't want to support his investment?
So all of the above, but you summarized it. The primary value proposition of Threads is that it is not Twitter. And not only whether you're biased, there's a lot of people who like Elon Musk, a lot of people who don't, but let's put that aside. The move to a blue check business model, which was just pay for play, no verification of identity, no attempt to do what open web does, and that is rank comments by the veracity of the commenter, the data, and de-escalate heinous hate posts. That like all of that's gone away. So what you have is a group of mostly MAGA hat wearing or Elon stans who paid for the blue check, and quite frankly, their content just isn't as good. It used to elevate great content. And the blue check said this person has some credibility and is who they say they are. Now it's the blue check pays $8 to get more of their content heard, which doesn't mean it's good content. So what you have is this inextricable downward spiral driven off a business model that no longer elevates content based on the content, but based on who has a blue check. And the result is, one, the content just isn't nearly as good. Two, because he has essentially fired his entire safety team, it's gotten so vile. I mean, it used to be, oh, that's ugly. Now it's literally become noxious. The shit that, not me so much, but the shit that some of the people I know have to endure now, and just just how creepy and angry some of the dialogue has gotten on this platform. And then you look at the advertisers, it's literally ear cleaners and payday loan. Because no credible advertiser wants to have, Unilever's just not going to tolerate Dove, an ad for Dove showing up next to a swastika. And that's what you're dealing with when you advertise on Twitter. In addition, the management team is the team that keeps on giving here. This whole rate limit exceeded bullshit. No one can figure out what happened there. And then he comes out to explain it, which was basically him saying, the CEO, Linda Yaccarino, really isn't the CEO. Why is he announcing this? She should absolutely be announcing these kind of things. So what do you have? You have, one, it's not Twitter. And two, they're going to learn from the mistakes of Twitter, just as they learned from Snap. Snap really was the R&D department for Meta. Meta has no shame about ripping off. It feels very Twitter-like, but it feels cleaner. And so far, no one's calling me a libtard or, no, there isn't a lot of name calling, at least in the 7 hours I've been on it so far.
Give it time.
Give it time.
Day one.
But I think that they're...
So, I mean, my follow-up question, like, do you think Threads is going to be any better? The company that pushed nooses to teenage girls? I mean, why is there any indication in your mind that Threads is going to come up with a cleaner, more high quality content diet through its algorithm than Twitter would?
Meta cares about money, and money for most of the time leads you to a productive, good place. I believe in capitalism. So people want inspiring, good content. The problem is the algorithms also sense that sexualized photographs or provocative photographs of people, no matter how young, gets a lot of viewership, so they let that run free. Rage, they let that run free. But Twitter has become, Meta doesn't do nearly the job they should, but Meta does have a safety team. I would bet it's now 5 to 10 times, if not 20 times. There's no one home at Twitter. They can't even get a podcast where they announce, or Governor DeSantis announces his presidential run with the founder of Twitter. Twitter is literally an empty shell. It's an empty, it's a shadow of itself. And so I find that the service itself and the content has just gotten so bad. Now, having said that, will Meta do anything to be less of a drag on the Commonwealth? Will they do anything to slow the acceleration in the rates of teen depression and self-cutting? No, they won't. But this product, I believe, so far shows real signs of success. And the story we didn't have in our notes, but it's worth mentioning, was that I think it was a Louisiana judge ruled that people in the government can no longer speak to social media platforms, and what is sort of another manifestation of the Trump presidency appointing far right jurors or people on the bench, and him deciding that free speech means the government is not allowed to speak to social media platforms. I got to believe this thing's going to be overturned. But you now have Nick Clegg going, I can do whatever the fuck I want, send out images of nooses, pills, and razors to any 14-year-old. And the government can't even issue a warning. The government can't even call me and complain about it. So there's problems across social media. I think we're about to see the mother of all misinformation in the first half of next year as we move into an election where we have a murderous autocrat who, if he doesn't get some victory in Ukraine, is going to find he's put in an office on the 11th floor with a big window. And the fastest way for him to a blue line victory would be if Trump gets reelected. And then you have these amoral management teams. You have Twitter, which is just totally off the rails. And you have Meta, which will always opt for thoughtful consternation and doing nothing as long as the check clears. So it's going to be the mother of all misinformation. But I do think Threads is going to be a better experience than Twitter. Twitter's just, Mark Zuckerberg isn't going to put out a thing saying, oh, your rate limit has been exceeded. We're limiting your viewership. I mean, I didn't even know what that meant. It was like it was like I was watching, I don't know, the Umbrella Academy on Netflix, and they stop and say, sorry, download bandwidth exceeded. We're sending you this on DVD. I didn't know what it meant. I was confused.
And he increased the limit like 2 hours later. Yeah, I don't think he really understood what it really
We didn't know if it was him trying to cover up a technical glitch or them trying to shove more people, motivate more people to sign up for a blue check. It just felt like a cover up or desperate, or probably what it was, just some guy's blood sugar and incompetence, and him calling one of his 11 remaining engineers saying, tell him the rate limit's exceeded and see what happens. I mean, it's just, it feels as if there is absolutely no one home. It feels like Al Pacino in Scarface when he's snorting 10 pounds of cocaine as the cartel surrounds his house and he's just making decisions, kind of happenstance.
What are we going to do now? We're going to war. That's what we're going to do. We're going to eat that salsa for breakfast. Close that fucker down.
Yeah, just makes me think back to all those comments saying, this guy builds rockets. You think he can't build a social media company? It's
no.
Like,
yeah, he can build a rocket. It's an entirely different skill set.
Well, anyway, I'm excited to see all the libtard comments come in, but I do want to take this one moment just to give some praise to Mark Zuckerberg. So he's been called a copycat throughout his entire career, and it's been a way of ridiculing him. And there have been failures when he's copied products. So he tried to copy YouTube when he did Instagram TV. He bought the Oculus, which, copying, he just acquired the company, and the MetaQuest has been a massive failure. But I also want to just go through like some of his wins. So in 2012, he bought Instagram, now has 2 billion users, basically the biggest social media company in the world. 2014, he acquired WhatsApp, also has 2 billion users. 2016, he started Instagram Stories, which he copied from Snapchat. And within a year, he had more people using Instagram Stories than Snapchat had across all of its users combined. And then in 2022, he started Instagram Reels, copied TikTok, and now he has 2 billion people using Reels every day. And I just think we should give credit to Mark Zuckerberg. I mean, there's that great Picasso quote, which is good artists copy, great artists steal. I feel like we're witnessing, you can call him out for being weird and for being a lizard and also for all of the misinformation stuff. But I feel like we're witnessing the greatest corporate artist of all time. And in a world where, he's showing that M&A and copycat products is truly an art form, and he's taken over the world with it. So I just want to give him the credit that I think he deserves on that front.
He's a brilliant business mind. and next to Elon Musk, he looks rational and nice. But let's
Yeah.
not protect. Let's not protect. I mean, Elon Musk. He strikes me as being a terrible role model for young men and young business leaders.
Yeah.
He strikes me as somebody who is reckless with the people he knows. He accuses his coworkers of sex crimes. He doesn't pay his bills. I don't think he acquits himself well. Having said that, I believe he's good for humanity. I believe that the electrification of the auto industry and space exploration are all things that are going to move humanity forward. So really big picture, you would rather have Musk than not have him. On the other hand, Zuckerberg has become more of an adult. He's more measured, a family man, very intense about his stuff. I think he's a good manager. I think Facebook or Meta, on the other hand, is probably a pretty nice place to work, and I believe that they handle their employees with care. If you had a button to decide whether or not Meta should ever exist, you might push it. This organization has done real harm to the Commonwealth, to teens, to our elections. And he has to take responsibility for that. He's been in charge. So yeah, I would rather spend the weekend with Mark Zuckerberg than Elon Musk. But in a future world, if I can go back in time, I'm going to try and start a taco stand with my buddy, the Zuck, and keep him out of technology because Elon Musk, he's going to be good for the planet. Mark Zuckerberg, in my opinion, Mark Zuckerberg and Sheryl Sandberg have done real harm to the nation. And I think big tech on the whole, including Tesla, is a net positive for the world. The problem is with the word net. People say, well, they're good, leave them alone. No. Fertilizers, pesticides, and fossil fuels are net goods for society, but we have an EPA and an FDA. The only company you might argue that has maybe been a net negative of all of them is Meta. And he has to take responsibility for that. But for this moment, I'm on Threads and I'm loving it, Ed. I'm loving it.
Okay, let's move on to our third story. One of the oldest and best-known internet companies is planning to IPO, Yahoo. That's what CEO Jim Lanzone told the Financial Times, adding that the company is, quote, very profitable and ready financially. Yahoo has had an interesting and tumultuous history. The company went public in 1996 and quickly became one of the most popular websites in the world. At one point, it turned down a $47 billion acquisition bid from Microsoft. However, it has since regressed. In 2015, it was sold for just $5 billion to Verizon, which then resold it 6 years later at the same price to private equity giant Apollo. It's also had its fair share of management shakeups, with 8 different CEOs in its 28-year history. Now, we actually have some inside perspective on this story because Scott co-invested with Apollo back in 2021. So, Scott, what can you tell us about Yahoo's IPO plans?
So I'm not an insider. I'm not on the board, and I don't have any non-material public information. So let me just disclose that. I'm an investor. I co-invested with Apollo. So about 2-3 years ago, there's a couple of things here. The first is we hate old people. We're ageist. What do I mean by that? When your grandparents come to the Christmas party with all of your friends, or someone's parents show up at a party, everyone's nice to them, everyone's polite to them, everyone wants away from them. And that is really old people scare us. They smell funny and they remind us of death, and they have trouble hearing, and we don't want to be around them. And that's a very harsh, reductive thing to say, and it's absolutely true. We love being around young people. Young people are interesting and they represent hope. You would pay a lot of money. You would pay a lot of money to have, lunch or breakfast with Tom Brady or Gisele Bündchen. Having said that, people pay a shit ton of money for lunch with Warren Buffett, so maybe my argument doesn't hold. Anyways, I'm sticking with we're ageist.
Tom Brady's young? He just retired.
Well, he's young in my mind.
How about Odell Beckham Jr.?
Well, okay, a guy like that. Anyways, you get my point. But we love hanging out with the hot young people, and we love hanging out with hot young companies. Nothing gets the valuations of a small, cool, new thing that's growing. It gets just a ridiculous. It can trade for billions of dollars when it has no revenue. So we have this wild bias towards youth and this wild bias against the aged. And the same exact thing is true in the investment markets. And that is, I've invested in every stage of capital formation or the life cycle of companies, if you will. I've been an angel, I've been in venture, I've been in growth, I've been in IPOs. I've been in mature companies, cyclical investing, then distressed, where a company is going through bankruptcy. Hands down, where I have made the most money is in distressed, because no one wants near them. The same reason that you want to invest in seniors' homes. These aren't sexy businesses, but they make a ton of money. And what you have with the distressed business, one of my distressed companies was Dex or Thrive, a Yellow Pages company that's kind of pivoted to CRM software. We bought this thing for 2 times EBITDA, and we all knew it's going out of business, but it wasn't going out of business in 24 months. The same way Blockbuster took 12 years to go out of business. So if you bought a franchise, you could pick one up for 2 to 3 times cash flow, and you made a lot of money. These things trade really inexpensively. And then we went and bought other Yellow Pages companies, laid off the majority of the staff, and as long as we cut costs faster than the revenue declines, the company was growing earnings and EBITDA. And that, I think I did 4 or 6 or maybe even 8x on that investment. The same is true of my biggest investment recently, and that is Enjoy. We bought it out of bankruptcy. It was highly distressed, a big bet, a lot of risk, tremendous upside. The same thing is true with Yahoo, and that is I saw Yahoo as not a distressed property, but it was owned by the wrong player. Yahoo, in sort of a knee-jerk reflex gag reaction to AT&T buying Time Warner. And Verizon's like, well, we can't let AT&T get out of us, so it went and bought these digital assets, Yahoo and AOL. It didn't work. And the best assets to buy in terms of price are corporate orphans. Because Verizon, which does, I don't know, $100 billion plus in revenue and is worth a couple $100 billion, is like, I just want this shit off my plate. Sell it.
Yeah.
If we don't get, we don't want to wait and get a better price. We just want to be done with it. Get it off. We'll take the hit. Corporate orphans are literally the best purchases ever. And here's the thing. Yahoo was a shitty investment at $125 billion, but I was banking on the fact that at $5 billion, it was an amazing investment. And my thesis was incredibly complex, and it was the following. It's one of the 5 most trafficked sites in the world, and it's the only one of those 5 sets that trades for less than $1 trillion. I mean, whether it's YouTube or Meta, or Google, all of these things are trillion plus assets. And then there's Yahoo, which I think is the 5th or 6th most trafficked non-porn site in the world. And it's trading at, we had a chance to buy it at $5 billion. So I said to Apollo, I really want in on this. I love it. I can add value here. Yahoo Finance has been my homepage for, 25 years. With a public stock, they're going to be able to go roll up all of the remaining content, guys. I wouldn't be surprised if they acquire the distributor of this podcast, Vox, if they decide to get into the podcast game. And all of these things are trading at really, bargain basement prices right now. And they also do a very good job of monetizing that content. And then query me this: what is the 3rd largest company in a $150 billion sector called search? Well, we know who 1 is. 2 is Microsoft. Number 3 is Yahoo, and they make a shit ton of money in search. So for a lot of reasons, this is just, I'm very excited, Ed. I'm very excited. Distressed, growing, got in at a great price. I really like Jim Lanzone, the CEO. He strikes me as an adult. He's also quite handsome, which I think is important in a CEO. I think that's very important. And
fundamentals.
So I got into this thing, and it's already, like, I see the financials on this company. It's already a crazy winner. They got this, and this is public. Did
they share the financials with you when you invested, or do you get to look at the financials as an owner of the stock? Like, have you received a document outlining them?
I saw the financials when I was investing. I haven't kept up on the financials of the company, and this was public information.
Do you remember roughly what the earnings multiple was?
I think the company was doing somewhere between 5 and 700 million in EBITDA, and was we bought it for somewhere between $4.5 and $5 billion. But here's the thing, Ed. It had about $1 billion in cash, and then it immediately sold Yahoo Japan for, I think, about $1.5 billion. So you basically bought this company for about 3 or 4 times EBITDA, and they've been growing EBITDA. So, I mean, the way private equity works is you make a capital commitment, and then they call on that capital commitment. They never called the full amount of the capital because they didn't need it.
Right.
So this is going to be a home run. And the way you measure the success of a private equity or of any investment is the internal rate of return, meaning how long did it, how soon and how much money did you get back, right? So you'd rather get $20 back on $100 in a year than $30 back on that 100 in 2 years, right? It's how much, and how soon do you get your money back? This thing's going to have crazy IRRs, and it's going to have a public security to go start buying all the cats and dogs in digital media that don't have the scale. So anyways, I absolutely love this thing. And again, see above, animal spirits returning to the markets. You watch, this is going to be a big IPO. It's going to be, and it's kind of internet history for me. It's sort of like when John Travolta shows up in Pulp Fiction and has a kind of a, his career is reignited again. I love the fact that Yahoo is back. It's like, oh my gosh, who would have known that Michael Keaton would be in, win the best Oscar or whatever. So I love this thing. And I think there's some real investment lessons here. Find the shit no one else wants. The hot young thing always trades at a crazy multiple. It's ridiculous how much unearned attention hot young people get and how much we shun older people when they have a lot of value to add. And it's the same is true of companies. Older distressed companies are the best place to invest.
I was also going to ask, what kind of return are you looking for? I mean, you're talking about the IRR. Are you planning on selling at the IPO? Is there a price target you're searching for? What's your exit strategy, if any?
I'll look at the value. It's totally based on the valuation. I'll look at the valuation of the IPO. I'll look at how the stock trades on the offering. I'll look at the metrics and the numbers, and I'll decide whether I want to hold or not. But this is, this is a dream private equity investment. They don't call the majority of your capital because they can, refinance the company right away and sell pieces for a lot of money. And I mean, it's just. But I'll look at the value. Whether or not I sell will be based on valuation, but I'm inclined, unless the valuation is just crazy high, to hold. I like management, they're growing, and see above, 5th most traffic website in the world.
And finally, just some sort of tech M&A history. We're talking about Facebook, which feels like probably the greatest acquirer of all time. Yahoo might be the worst. So they bought a web hosting service way back in the day called GeoCities for $3.5 billion, which later shut down. Then they bought an internet radio company, broadcast.com, for $6 billion, shut down. They bought Tumblr for $1.1 billion and then sold it at a 99.77% discount for $3 million. Facebook makes it look easy. Yahoo is sort of case in point that it isn't. But from your experience on corporate boards and just running companies in general, what does the acquisition process usually look like? And what does it take to make a successful one, especially considering the fact that the CEO has stated that M&A is going to be a big part of his strategy moving forward?
Well, you said a lot there. So a couple of things. One, as someone who's, supposedly knows something about brand strategy, people often say, specifically the CMO or the person who feels like they should only be the one making decisions around brand and marketing, that brands are really fragile. I find that's not true. I find that strong brands are really enduring. It takes a lot to kill them. They're like Jason. Like you can do anything to this thing and it shows up with a hockey mask and it's back, right? Do you remember Cartier, which is one of the best luxury brands in the world? They were putting their brand on the side of Lincoln Town Cars in the 80s. I mean, you can really
I did not know that. That's crazy.
You can really try to fuck up a brand and it still might survive. This is what Yahoo, a global brand, has survived. It's survived arguably the worst CEO in tech in the last 20 years. Marissa Mayer, who everyone thought was, keep hope alive, a great backstory, Google, articulate, a terrible CEO. Took revenue down 20%, took EBITDA down 50%, and managed to walk away with $250 million. Hired her buddy from Google. He was fired 15 months later. She agreed to a severance package where I think he got something like $130 million or $200 million in severance. Almost managed to fuck up the tax structure of their Alibaba stake, which was worth more than the entire company. The company became a tracking stock for Alibaba. And you referenced probably the worst acquisition in history. And I'm not revising history here. This is true, and it's on video somewhere. I was invited to speak at something called P&G Signal. P&G gets all of its top leaders together around the world, and they bring in a bunch of people to speak to P&G. And the most important, a lot of people show up because they all want to sell ads or something into P&G. And I was on stage, and Instagram and Tumblr had both been acquired in the previous 90 days. And I said, best acquisition of the year, Instagram, worst acquisition, Tumblr. And you know who spoke
Really?
after me?
I don't know, Marissa?
Marissa Mayer was behind me, spoke after me. But essentially, it didn't take, and I knew this through firsthand usage, Tumblr was a porn site. And once they stopped, and Union Square Ventures basically did a masterful job pretending this chicken shit was chicken salad, selling it into their buddy Marissa for $1.1 billion, and it was basically a porn site with some design pages. No individual has made more money off of porn than Fred Wilson or a firm of Union Square Ventures. Tumblr was a porn site. They sold it for $1.1 billion. The moment they stopped the porn under pressure from advocates, its traffic dove and it was sold for $3 million. It is hard to find a company that goes from, there's been companies that have lost a lot more in gross value, right? Twitter has lost probably $40 billion in the last 6 months. But it's hard to imagine a company losing $1 billion plus acquisition going to 3 million, basically saying it's worth nothing. We bought nothing here. So Yahoo has endured one of the worst CEOs of the last decade, one of the worst acquisitions, and yet it endures. It has a global brand. People still show up to it. Do you use Yahoo, Ed?
No, that's why that top 5 global total traffic was just shocking to me. Never.
You never on it, not for finance, not for anything.
I used to use it for finance, but then we started using other tools.
Yeah.
But yeah, no, not really.
Well, I need you to start
You
it.
use it?
I need you to start. Yeah, I use.
You're good. You can exit soon.
I love Yahoo Finance. I love Yahoo Finance.
Yeah.
But anyways, Yahoo has endured, but I mean, it cost them. They went from 125 billion to 5. But my guess is this thing comes out. I mean, I was looking everywhere to try and see where they think the market valuation is. But my guess is this thing comes out somewhere between 10 and 20. And Apollo just prints an enormous IRR number. I love this. I absolutely love this.
Yeah. No, I'm sure. Yeah, it's big time. Okay, let's take a look at the week ahead. We'll see housing starts and existing home sales for June. And the second quarter earnings season kicks off with JP Morgan Chase, Wells Fargo, Citigroup, and BlackRock all reporting. Do you have any predictions about those earnings, Scott?
I don't have any predictions about earnings. My predictions are simple. I think, I only have one prediction. I think Threads is the best, going to arguably be the best. It's going to be everything for all the press that the mixed reality headset got from Apple. The actual launch here that's going to change things, the ecosystem, is what happened today with Threads.
Yeah. Do you have any thoughts about post news? I mean, sort of a conflict of interest to be.
No, I mean, I'm an investor.
Threads,
I'm an investor. I'm an investor in Post. I like it. This is gonna add. I mean, just the reality is, Thread's going to sign up more people than Post, Blue Sky, Mastodon in an hour. The question is, will other tech companies see a need to be in this space? Will they see an opportunity and want to go acquire niche players or teams? I mean, I'll give you an example. When I didn't invest in a Twitter competitor with Post, I invested in Noam Bardeen. And this is a guy who is arguably the best tech guy or the best product guy in the world of technology, or one of the 3 or 5 best in the world who isn't on a beach somewhere or going on summit at sea or hanging out in Singapore, whatever it is tech billionaires do after they've walked off with a bunch of money. And so I'm like, whatever happens here, I think I'm going to get my money back, because at the end of the day, someone is going to buy Post because they're going to want the team. And also he might find a niche around news, and somebody might step up and say, well, now Meta's in this, there's Twitter, we need to be in it. So I think it works on its own. And what was our biggest sign-up day? That whole rate limit exceeded bullshit 2 days ago. All of a sudden we had a bunch of signups. So, I mean, I just want to summarize by saying, distressed, don't be ageist. Look at valuations. And it's fun to be around hot young people, but guess what? They're really expensive. and hang out with seniors when you're investing. It's the best place to invest.
That's why I hang out with you.
That's why you hang out with me. Did you just say that? That's why you hang out with
That's
me?
right.
Anyways. And touche. Well
It's a
done.
good investment.
There you go. And then,
Sorry, I cut you off.
yeah, I forgot what I was saying. I forgot what, see above
Something
old.
about
I forgot
threads, maybe.
my train of thought.
Yeah.
Oh no, the two kind of investment principles I think you can take away from this are: one, distressed is, in my opinion, a great place to invest. And two, invest in management teams. That should kind of be your, when you're investing early, it's really all about the team. The right team will figure it out or get your money back. And it's like a great chip on upside. They could do something crazy and they almost always get you your money back. Okay, Ed. Thank you for watching this version of Prof G Markets. Check out our pod feed for office hours on Wednesday, and we'll be back with a fresh take on markets every Monday.